In this chapter, we'll discuss about some general points on home loans. In the previous chapter, we discussed only legal aspect pertaining to home loans. In this chapter, we'll discuss about the other general points. So, how banks fixes repayment is one question, that is the installment amount. So, repayment capacity is based on your monthly income, okay, which in turn is dependent on many factors like what are your monthly expenses and so on. And the main concern of bank is that you can comfortably repay the loan. So they'll fix the time based on that. Okay, so the higher is your income, the higher will be the amount you'll be eligible for the loan. Typically, banks assume like 50 to 60% of your income is available for repayment of loan. However, some banks calculate the income based on gross income and not on disposable income. And all these are there. We do not get into the actual calculation, but only the broad criteria will be your income. How the bank fixes repayment will be based on the income. And repayment usually by way of EMIs in case of individual loans. EMIs means we discussed equated monthly installments. So till the end of the loan payment, every month a constant amount will be repaid. We also discussed about fixed rate home loans and floating rate. In general, we discussed not about home loans, but fixed rate loans and floating rate loans, their advantages and disadvantages. So in case of home loans also, banks offer both fixed rate and floating rates. Fixed rate loan, the rate of interest will be fixed for the entire duration of that loan. Okay, so EMI will be known in advance. So for a family, this can be good in terms of budgeting. The disadvantages is like if the interest rate, the general interest rate in the economy is like decreasing, you will not get the benefit of that lower rates. Okay, but if it is increasing in general, it will be advantage. However, banks have become clever. There were particular periods of time where the interest rates were increasing, and because these fixed rate borrowers are getting the benefit, banks has introduced a term called reset clause. A reset clause is like, in case of fixed rate of interest in the sanction letter, they will say this is a fixed rate of interest, but banks will have the right to reset the clause. Reset in the sense that, say for example, the sanction letter says the fixed rate of interest is 7%, which means it is not linked to base rate. If it is a floating rate, it will be linked to base rate, like base rate plus 2% something. Fixed rate is fixed rate 7%, but they'll have a clause called reset clause, and saying that in cases of some circumstances which bank will decide, which usually is like the interest rate is increasing generally throughout the economy, then they'll have the right to reset this fixed rate, and maybe then they will increase the rate of interest by 0.25 or 0.5%. Then you might say, how is it a fixed rate? Well, really, banks truly don't offer fixed rates. They have this reset clause. So in a true sense of the word, really all rates are sort of floating, but at least fixed rate, the change doesn't happen frequently. Like in extreme cases it happens, but usually for every change in base rate, it doesn't happen. So floating rate home loans, the EMI will change with changes in market interest rate, and if the market rates are increasing, your repayment will increase. If it falls, it will fall. Okay, your repayment will fall. So the floating rate, as we discussed earlier in an earlier chapter, it is made up of two parts: base rate, the index basically, and a spread. That index is usually called base rate for banks. Index is anything, and index is like a one indicator that captures the interest rate environment. So for banks, it is the base rate. We discuss what base rate is, and the spread will be usually same. So if it's base rate plus 2%, the spread, the 2% will remain same, but base rate can change based on external factors. So if this base rate or this index moves up, so interest rate of this floating rate will also increase, or if it falls, your rate of interest will also decrease. And EMIs, theoretically EMI should also change, right? If the floating rate of interest changes, the EMI should also change. But what banks usually do is they make some adjustments to ensure that the EMI is constant throughout. So either they adjust the repayment period, or through some adjustment they try to make the EMI by and large same. Then there is something called flexibility in EMI. Some banks offer these customers flexible repayment options like step-up loans. Step-up loans is like, we discussed about when discussing about corporate facilities, we discussed something called ballooning repayment, right? So something similar to that for individual customers also, banks will give some flexibility in EMI. So maybe like EMI can be low initially, and as the years increase, the EMI will increase. Or in case of step down loans, EMI will be high initially and decreases as the years roll by. Okay, so who wants these step down loans? So maybe people who are close to retirement, maybe now they can afford higher EMIs, but towards the end they will like to reduce the expenditure because they're about to retire. They need savings, so step down loans may be required for them. So step up option is convenient for borrowers who are in the beginning of their careers. Okay, youngsters of 30-35 years who can afford to make larger EMIs in the later stages, because then their salary will increase once they get seniority. They can afford to pay more EMIs, so they might opt for step up option. Step down option is useful for borrowers who are close to their retirement years. There's a term called monthly reducing balance method. So borrowers will benefit if the loan is calculated on the monthly reducing balance rather than annual basis. Okay, so in case of monthly resets, interest is calculated on the outstanding principal balance for that year. So what is done is that the principal paid is every month you make some EMI, right? So the principal portion of the EMI, the principal will be deducted from the opening principal, and based on that new principal, interest will be compounded on the reduced principal outstanding. In case of annual resets, principal paid is adjusted only at the end of the year. So you continue to pay interest on that portion of that principal that has been paid back. So even though, so there are two cases here. One, you are making EMI payments every month. So your principal, the principal portion is reducing every month. So if the bank applies that the interest rate on that reduced principal at every month, it's an advantage to you. But if it applies that interest at the end of the year, so even though you are paying EMIs every month, you're still equivalently paying interest on the paid amount. Even though you have paid off the part of the loan, still you are continuing to pay interest. Okay, so that is why there's a disadvantage. Monthly reducing balance method is more beneficial for customers. Then another question is, how does tenure affect cost of loan? Tenure is like, the longer the tenure, the lower will be EMI. Okay, so compared to a loan, if a bank stipulates this loan is to be repaid in 3 months, 3 years, and another loan, the same amount, if they say the loan is to be repaid in 5 years, so the difference here is the EMI will be lower in case of 5 years, because you are getting more time to pay that same amount, so it will be lower. But here is the point: shorter tenure, like the loan in 3 years, it means what it means. Even though your repayment is high, EMI, it will be repaid faster. Okay, loans for a higher period, in this case 5 years, even though your per month EMI is less, on the whole you end up paying more amount because you're paying more interest. Okay, so if bank give an option like you want to repay a loan in 5 years or 20 years, you might think that 20 years, say the loan amount is 1 lakh. Okay, 1 lakh, one option is you pay in EMI in 5 years. So that is 12 into 5, 60 EMIs. Another option is 20 years, 20 into 12, 240 EMIs. So one is 60 EMIs and this 240 EMIs. For the loan of 1 lakh, if it is 240 EMIs, your per month EMI will be very less compared to 5 years repayment. But for this 20 years, you're paying interest. Okay, this is not coming free to you. You have to pay interest on it. So shorter tenure means even though it's a greater EMI burden, because the loan is repaid faster, the interest component will be lesser. So how does tenure affect cost of the loan? Tenure affects, if it is a shorter tenure, the EMI will be higher, but the effective cost will be lower because you're paying lower interest. Then there's something called amortization schedule. Basically, it's a table that gives the periodic principal and interest payments. So there'll be a opening balance for every month. Say if the loan repayment is for 10 years, so 120 months, there'll be 120 rows, and the columns will be like opening, what is the opening amount, what is the payment they have made, EMI for that month, what is the interest they have charged, and what is the closing balance. So this table, like, where it gives the periodic principal and interest payments and the amount outstanding at any point of time is known as amortization schedule. There's something called pre-EMI interest. Sometimes loan is dispersed in installments depending on the stages of the completion of the project. So pending final disbursement, you might be required to pay interest only on the portion of the loan disbursed. This is called pre-EMI interest. Pre-EMI interest is payable every month from the date of disbursement up to the date of commencement of EMI. But usually banks these days are also offering us facility where customers can choose the installment they wish to pay for under construction properties till the time the property is ready for possession. And any payment over and above the interest by the customer goes toward principal repayment. Pre-EMI interest is a bit confusing topic. You might ignore that. Then what securities provide for sanction of housing loans? We discussed in case of companies, they offer various securities like collateral securities and all. In case of housing loans, banks usually do not take any security because the house itself is valuable. So the security will be the primary security itself. Primary security means that house. We discussed that primary security is the asset created out of the bank loan. So in case of housing loan, the property will be the primary security. So the security in case of housing loan is that mortgage of the property. We discussed about mortgage, hypothecation, pledge. Okay, so mortgage is in respect of immovable properties where the title deed is deposited. So if they ask you in interviews what is the security for housing loans, it is mortgage of the property by way of deposit of title deeds. If required, bank may ask if the loan amount is higher. Bank may also ask collateral security, but usually that is not asked. Okay. Bank sometimes insist on down payment. Down payment is like borrower's contribution. Okay. So say the loan is like for 5 lakhs. Maybe they'll sanction only 4.5 lakhs. That 50,000 will be the borrower's contribution. Okay, that's the down payment. And collateral security, if they insist, could be for individuals. It could be life insurance policies. Okay, it could be NSCs. That's the national savings certificates, which we will discuss later. Shares and variety of other options. So banks will also require you that you have to ensure that the title of the property is free from any encumbrance. Okay, that we discussed earlier. Down payment margin. So that depends from bank to bank. It could be 20-30%, depends on the bank. But there are banks which are giving even for as less as 5%, which means 95% of the loan of the property value they're sanctioning. So for a 50 lakhs property, they're even sanctioning 95% of the 50 lakhs. But it depends on how aggressive the bank is in the marketing. Some may insist 10-20%, some may do it as low as 5%. Then prepayment. Sometimes okay, there will be this repayment as per the sanction letter. There will be this repayment. So every month you have to make this EMI. Sometimes you might have surplus funds. Say suddenly you received bonus in your company and you want to prepay early repayment of your loan. Banks in those cases charge prepayment penalty, say 2-3% of that whatever is outstanding as on that date. Okay, and it varies basically depending on the source of funds. If you get a loan from other bank, usually that the charge will be higher. We discussed about takeover of loans, right? So if it's a takeover of loan, usually the charge will be higher, but if it is from your own sources, it will be less. Basically, if you credit more EMI into your account on a periodic basis and try to bring down the interest burden, most banks do not charge a penalty on that, right? If you deposit more EMI on a periodic basis, but if you try to close the loan and giving a lump sum, banks usually charge a prepayment penalty. You might wonder why are banks charging this prepayment penalty, because in a way it's good, right? Because when many customers are defaulting and there are a lot of NPS, you are paying before the due date and it's good news for the bank. But the problem is we discussed briefly about asset liability management earlier. So banks will be assuming that your repayment is so years, say 10 years, bank has planned accordingly. So to give you funds, so the bank has this balancing act to do. On one hand, it raises deposits from depositors, and on the other hand, it lends to companies and borrowers like you. Okay, so to balance these two should be same. There can't be a case where there are more deposits and less loans, in which case bank will be having surplus funds, and that is of no use to the bank. They can't have the other case where many people are asking for loans but deposits are less. They lose out business on that. So the banks always try to do this balancing act. Okay, so if they sense that deposits are more and loans are less, people are taking less loans, they'll reduce rate of interest on loans and try to boost up the loans. They'll attract more customers and vice versa. So they always do this balancing act. So if you prepay the loan, it upsets their plan. It's not about your individual borrower like you, but if many people do this, okay, so bank has arranged funds or lent funds based on some planning. So say as per your sanction, you have to repay the loan in 10 years, but now you're repaying in 7 years. Bank has raised, assuming that it will not get back funds from you for 10 years, or based on a EMI repayment based on 10 years, bank has raised funds from outside parties, maybe has taken loans from some other bank or some multinational agency, assuming that you will not pay till 10 years, but suddenly you are now paying back. So had the bank known this earlier, it would have borrowed from outside parties, which is more expensive, right? So these sort of things are there. So banks, that's why charge prepayment penalty. Then there's something called switchover charges. So when other banks reduce interest rate, you might be tempted to close your loan with this bank and shift to the other bank. Then banks will charge some charges. And in fact, to avoid customers do not approach other banks for this reduced interest rates, bank usually allow customers to switch over from higher rate to lower rate if it is possible. Then there is a tax benefit on housing loans. So if you have taken a housing loan, at the time of paying, of calculating taxes, once in a year you calculate taxes, interest repayment up to 1,50,000 per annum will be, you will be entitled for income tax rebate, okay? And as per section 80C, on the principal amount also you will be allowed have tax benefit up to 1 lakh. And then there's a loan called reverse mortgage loan. We have discussed this about briefly. Like this is a product for the benefit of senior citizens. Who have a house but they don't have adequate income to meet their needs. So what they can do is like this is usually eligible for people who are above 60 years of age, okay, and who have a property in their name. So borrower will receive some lump sum amount, say 10 lakhs or something, lump sum, in exchange for this property. So the property should be very clear, from all income rates and all. So they need not make any repayment. So this elderly couple has taken this 10 lakhs loan, reverse mortgage loan, in exchange of this property. This 10 lakhs, then there are no EMIs to be paid. This is the concept of reverse mortgage. No repayment is made as long as the borrower lives. But borrowers, of course, should meet the taxes and other maintenance of the property. So, and the loan, how much loan that, whether it's 10 lakhs or 20 lakhs, depends on the property value, the age of the borrowers, most importantly. Because till they die, bank will, the repayment will not come, right? So, the loan will, when will bank get back this loan, 10 lakhs? So, the loan will become payable only when the last surviving borrower dies or would like to sell the home, okay? So, on the death of this homeowner, the legal heirs will be given a choice. Either you want to keep the property or to sell it. So, if they decide to sell the house, the proceeds of the sale will be used to close the loan. Otherwise, they will arrange the funds from somewhere and get back the property, okay? And as per the scheme formulated by National Housing Bank, the maximum period of the loan is 15 years. And the residual life of the property should be at least 20 years. So, if the borrower lives longer than 15 years, the periodic payments will not be made to the lender. So, there is this option whether it's a periodic payment or lump sum payment, that it varies from bank to bank. But basically, this is the concept of reverse mortgage loan. So, the questions in the chapter you have to be prepared are how bank fixes repayment, that is installment amount. We discussed this is based on the income of the applicant. What are the two types of interest rates we discuss? What is fixed rate loan, advantages, disadvantages? What is floating rate loan, advantages, disadvantages? What is reset clause? What is index and spread? What happens to the rate of interest to be paid if index increases? If index increases, the rate of interest will also increase in case of floating rate loans. What is step up option? What is step down option? Advantages we discussed. What is monthly reducing balance? What is difference between monthly reset and annual reset? How does tenure affect cost of loan? What is amortization schedule? What is pre-EMI interest? What securities to be provided? What securities to be provided for sanction of housing loans? Usually only primary security. Okay, mortgage on the property by way of deposit at title deeds. In some cases, maybe some high property cases, banks will ask for collateral security. So, what collateral security should bank usually take for sanction of housing loans? Any individual properties, like it could be life insurance policies or national savings certificates. What is down payment? What is prepayment? What is switchover charges? All this to discuss. What are the tax benefits to discuss? What is reverse mortgage loan? What is the age eligibility? Usually it is 60 years. When does the reverse mortgage loan become due and payable? We discussed this also.